Hey everyone, Daniel here. In this video, we'll be looking at the previous corrections and bear markets of the S&P 500 since the year 1928. Doing so will help equip us with a deeper understanding of what to expect in times of significant drawdowns and losses and what we should do to protect our investments. Without further ado, let's get started. Correction and bear market. Now let us first define what is a correction and what is a bear market. A correction is a decline of 10% or greater, while a bear market is a decline of 20% or greater in price of a security, asset, or financial market. While bear market occur less frequently than a correction, the occurrence of a market correction is more common than what most people will realize. On average, the stock market undergoes one correction every 1 to 2 years, and eventually, 14% of this correction turns into a bear market. Since 1928, the S&P 500 has experienced over 90 plus corrections and 28 bear markets, during which the average correction lasted around 3 to 4 months and prices dropped around 13 to 14% during the period. On the other hand, the average bear market lasted around 10 months and prices dropped around 36% during that period. Now, while corrections are commonly caused by a sudden change in investor sentiment, a bear market is commonly caused by economic factors that often result in a recession. Such factors include excessive speculation in the stock market, high inflation rate, rising unemployment rates, rising interest rates, as well as declining in corporate profits. What to do during a correction or a bear market? Now that we've understood what an average correction or bear market would look like, what can we do during a correction or bear market to protect our investment performances? If you have a broadly diversified and disciplined approach, you will likely do well if you were to stay the course during a correction or a bear market. Now, we've all heard of the saying that time in the market beats timing the market. And the reason why this saying works is because if you are investing in a broadly diversified market that is growing, the market will typically trend upwards and you will eventually recover from your losses during a correction or a bear market. Now, we've seen this over and over again over the last 100 years, and this is because if you are investing in a broadly diversified market that is growing, the companies within the index such as the S&P are more likely to survive through a recession instead of going bankrupt. Now, even if some of the companies within the index were to go bankrupt, you will still not be badly affected as it will only represent a very small portion of your entire investment allocation. Furthermore, if the companies can grow and improve their earnings after periods of recession, the value of your investment will tend to increase over time. That said, this saying will only hold up if you are investing in a broadly diversified market that is growing instead of just picking a handful of stocks and shares. If you are investing in a broadly diversified market, the last thing you want to do during a correction or a bear market is to immediately sell off your investments in panic or to be forced to sell off your investments due to circumstances, which brings me to my last point. So why do investors end up selling during a correction or a bear market? Well, all of us understand that the worst thing to do during a correction or a bear market is to sell off our investments. In reality, many investors still find themselves selling off their investments in the worst possible time. And the reason why they would do that is either because they succumb to their emotions and sold off their investments in panic, or they are affected by the accompanying recessions and are forced to sell off their investments to pay for their expenses or liabilities. If you have trouble controlling your emotions such as fear or anxiety during a bear market, the best thing that you can do is to brush up on your knowledge and deepen your understandings of the market. And that way, you are not easily swayed by clickbaity headlines or day-to-day price movements. If you want to avoid selling due to circumstances, what you can do is to plan your finances properly and set aside sufficient buffers and cash flow for your short-term needs so that you won't need to draw down on your long-term investments. Now, if you do not know how to get started with your investments or if you do not have the time to manage your own investments, you can check out what I do on my website to see how you can benefit from my investment planning services and reach out to me directly. If you found this video useful, do drop me a like and subscribe to this channel to stay updated with the weekly upload. Stay safe and I hope to hear from you soon.